good morning, everyone. This is Financial Literacy 101. And today we'll be talking about one of the ways that many Americans have become millionaires. What we know, ladies and gentlemen, that so many millions of Americans have become millionaires. We understand that the population of America is 330 million. And believe me, almost over half of those millionaires have become millionaires because of real estate investing. And one of the parts of real estate investing is rental properties. Now, if you invest in rental properties, you become a landlord, a slumlord, however you want to look at it. But you need to consider if you become comfortable in that role, because it's essentially, as a landlord, as a slumlord, you'll be responsible for things like paying the mortgage, property tax, insurance, maintaining the property, finding tenants, finding people to rent from, dealing with any sort of problems that may arise. Unless you hire a property manager or a property manager firm to handle the details, being a landlord is hands-on investments. Depending on your situation, taking care of the property and the people who rent from you, the tenants, can be a 24/7 job. And the one that's not always pleasant. I mean, you might have to get up late at night, have to fix certain issues, call a Roto-Rooter, call someone who fix a dirty sink out of one of your units, out of one of your apartments. Now, if you choose your properties and tenants carefully, however, you can lower the risk of having major problems. And I know what we're thinking about. We're thinking about the projects, the ghetto, low income areas that you're going to have the most issues, going to have the most trouble. And if you raise your prices, if you buy quality property in a quality neighborhood and you do fair pricing, anywhere from $1,200 and up, you're going to kill all the riffraff. Now, one way landlords make money is by collecting rent, right? Self-explanatory. How much rent can you charge depends on, okay, how much rent you can charge on depends on where the rental is located, whether it be an apartment, a house, a duplex, etc. Still, it can be difficult to determine the best rent, because if you charge too much, you'll chase tenants away, or you won't even get any tenants. And if you keep raising prices, soon your apartment building will be empty, I assure you. And if you charge too little, you'll leave money on the table, okay? That's why it's always important to do the comps, the comparables in that particular area. I mean, a common strategy is to charge enough rent to cover expenses until the mortgage has been paid off, at which time the majority of rent becomes profitable or becomes profit. The other primary way that landlords like yourself make money is through appreciation. If your property appreciates in value, the property itself appreciates in value, you may be able to sell it at a profit, okay, when the time is right. Borrow against the equity to make your next investment. While real estate does tend to appreciate, believe me, there are no guarantees. I mean, you can go by historical prices, historical asset values that futuristically have projections, so you can see if you buy this property at the current price, where could your potential profit be? Where could your potential asset be, and the value of it all? Now, another way that a lot of people who become millionaires, even one of my friends, became millionaires by flipping houses. Now, like day traders, and we talked about day traders, who are essentially leagues away from buy and hold investors like myself, real estate flippers are entirely different breed from buy and rent landlords. I mean, flippers buy properties with the intention of holding them for a short period of time, like no more than 3 to 4 months. And if they could hold it on for 30 days, they would. But more times than not, they have to repair and update that property, also known as rehab. But the thing about what they're doing is flipping properties. They're doing quick selling for a profit. I mean, when you think about it, two primary approaches to flipping a property. One, repair and update the property, also known as rehab. Because with this approach, you buy a property that you think will increase in value, a property that you think will increase in value with certain repairs and updates. Ideally, you complete the work as quickly as possible and then sell at a price that exceeds your total investment, okay? And that includes renovations. The second one is hold and resell. This type of flipping works differently. Instead of buying a property and fixing it up, you buy in a rapidly rising market, hold for a few months, and then sell for a profit, okay? The one that I love that you really don't have no hands on, whether it be flipping or buy, hold, and rent. This one is REITs. I mean, a real estate investment trust, okay? I talk about these a lot, but let me break down what a REIT really is very quickly, okay? A REIT, again, is a real estate investment trust. It's created when a corporation or a trust is formed to use investors' money to purchase, operate, and sell income producing properties. Now, REITs are bought and sold on major exchanges like stocks and exchange traded funds. You know, I love my ETFs. Now, REITs are in these. REITs are in individual stocks and also in your ETFs. Now, to qualify as a REIT, okay, this is on the other side. The entity must pay out 90% of its taxable profits in the form of dividends to shareholders. So when you are investing inside of a REIT, that particular trust, that particular corporation has agreed, with FTC and the SEC to pay out 90% of its profits to its shareholders in dividend forms more so than not. Now, by doing this, the REIT avoid paying corporate income tax. Okay, they avoid it by paying corporate income tax, whereas a regular company would be taxed on its profits, thus eating into the returns it could distribute to its shareholders. Now, like much regular dividend-paying stocks, REITs are appropriated for investors who want regular income through offer the opportunity for appreciation. And basically what that means is you just hold on to that property and you're going to get dividends after dividends after dividends, because REITs invest in a variety of properties such as malls, houses, healthcare facility, office buildings, you name it, they invest inside of it. Because in comparison to other types of real estate investment, REITs have been the benefit of being highly liquid, okay, liquid cash. So these are some of the fun ways that you guys can invest in real estate. We either be hands-on, where you buy, hold, and rent out the property, or hands-on and flip the property, or buy into a REIT. And of course, you have all sorts of real estate investment groups you can try to be a part of. You also have real estate limited partnerships you can be a part of. And what I like, which is hands off, are those REITs, what are basically real estate mutual funds that you can get into and do that. And your question is, why invest in real estate? You think I would ask that in the beginning, but no, now that you have the information, why invest in real estate? Because real estate can enhance the risk and return profile of an investor's portfolio, offering competitive risk adjustment returns. But in general, the real estate market is one of the low volatilities. I've been talking about volatility, how things are volatile, et cetera, et cetera, et cetera. We're talking about individual stocks. We understand the AMC, GameStop, all these volatile stocks that are being short squeezed. Can a property be short squeezed in the sense of the matter of the definition? Yes, but not on the same terms as the stock market, okay? Because again, it just has low volatility because you're owning land, okay? Not just the property that the land sits on, but you're owning land and the property itself, okay? So are somewhat two joint ventures. Now, when you compare the housing market to, let's say, equities and bonds, it's low volatility. Now, real estate is also attractive when compared with more traditional sources of income. Take, for instance, asset class. Typically trades at a yield premium to your stocks, your U.S. treasuries and assets. And it's especially attractive in the environment where the treasury rates are low. And here's another thing where you can diversify and protect, because another benefit of investing in real estate is its diversification potential. Real estate has a low and in some cases negative correlation with other major asset classes, meaning when stocks are down, real estate is often up. This means the additional of real estate to a portfolio like yourself, part of your stock portfolio, but this is just your total investment portfolio, okay? You have a stock portfolio, you have a bond portfolio, you have an index, ETF portfolio, but you have an investing portfolio. And what real estate can do, it can lower its volatility and provide a higher return per unit of risk. Now, the more direct real estate investment, the better the hedge, less direct. Publicly traded vehicles such as REITs are going to reflect the overall stock market's performance. You know where I'm leaning. If you do not want to get your hands dirty one way or another, REITs are the way that you should go. Let me say it loud and proud. If you are not a hands-on investor, you want to sit back and collect cash, you should be looking for REITs and not flipping property or buying, rent, and hold and all those other things, okay? Now, inflation hedging, last but not least. The inflation hedging capability of real estate stems from the positive relationship between GDP, as we all know, gross domestic product. Now, growth and demand for real estate. As economies expand, think about it, we're talking about economics. As economies expand, the demand for real estate drives rents higher And this in turn translates into higher capital values. Now, here's the thing. When you buy a property, take for the property that you guys should be looking at, okay? Like this. And they're not showing my property. Okay. Let's look at these properties, ladies and gentlemen. I really want you to see this property. That way you understand exactly what I'm talking about. Because when you buy a property, and it depends on how long you have the property, okay? It depends on how long you have the property, that essentially, when you first buy that property and you hold that property for at least 5 years, statistics show more times than not, then that property would at least raise 30% in value after 5 years, 60% in value after 7 to 8 years, and almost 70% in value from where you bought it at. I know people that are essentially hanging around, okay? They are hanging around and they have properties. Think about this. They have properties that they have bought 10, 15, 20 years ago for $150,000, and now that property is worth $500,000. Okay? 5 or 10. Yeah, there is a period where you have to wait, unfortunately, but is it worth it? I will say yes. I believe that it's very, very worth it, and that real estate investing is one of the most profitable ways that you can multiply your money more times than not. But there's a lot of things you have to think about, because when we talk about inflation, that's a real thing. But inflation shouldn't affect you, because as prices go up, so will rent. As prices go up, so will your resale value. And that means it's going to increase your profit, because you still bought the property 10 years ago, and now the property is worth 30, 50, 60, 70, 80% more than what you bought it for. So when you think about that, therefore, real estate tends to maintain the purchasing power of capital. Okay, not only does it maintain it, but it multiplies it. And by passing some of the inflammatory or inflationary pressures onto tenants, by incorporating some inflationary pressures in the form of capital appreciation, okay? We're not going to get into the power of leveraging with real estate investing, especially REITs. Because think about it. It gives an investor one tool that is not available to you on the stock market. Leverage. If you want to buy a stock, you have to pay the full value of the stock at the time you place the order, more times than not, okay? If you want to own a whole share. I know we deal in fractional investing, so you can own 1.5, 1.3 part of a share, but if you want whole shares, you have to pay the entire full price. But even then, the percentage you can borrow is still much less with real estate, thanks to the magical financial method of mortgage. Because you can do a reverse mortgage, you can do a refi, and you can actually take money out of the home, okay? However, there's many ways to leverage a property for you to bring in more money to multiply and buy another property, okay? When it comes to real estate, when it comes to stock market investing, there's really no way to leverage. There's a way to hedge, kind of protect your stocks by buying ETF and index funds and bonds and different sorts of securities, like TIPS, Treasury Inflation Protection Securities. There's way to hedge your stock portfolio, but there's really no way to leverage your stock portfolio. Well, ladies and gentlemen, happy Thursday to you. This is Financial Literacy 101. Learn money and be inspired. You guys have a great and wonderful day. I'm out.